Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome once again, Art Jarvis and listeners, to Taking Stock, episode number 15. Welcome back.
Happy to be here. Merry Christmas.
Merry Christmas to you.
Thank you very much.
And we're going to say right now, too, and Happy New Year, because this episode number 15 is the final Taking Stock for 2023.
Yeah. Year went fast, didn't it?
It did.
Yeah.
I mean, seriously, it did, didn't it?
Way too fast.
Yeah. Wow.
I say time flies whether you're having fun or not.
Well, you know what? I hope that you've had as much fun and gotten the enjoyment out of sharing this time and sharing, the story of our economy, the story of the investment world with our listeners. And hopefully we're gathering some momentum, getting some more with each episode. People that are, as you're listening to this, share it with your friends. Tell them to join us. We'll be coming back in 2024 stronger than ever with Taking Stock.
Yeah, most certainly. Yeah, I mean, 2023, for me, it's been fantastic. I've really enjoyed this. I enjoy this, the Taking Stock with you, and it's been nice. People come up and make comments that they listen to it, and they appreciate what we talk about and things like that. So it's good. If the worst thing you do is help some people out in the long run, you're doing the right thing. So
well, that's what we're here for. It's like some good investment information, news, and we don't want to flat out call it advice because I'm not here. Art Jarvis is not here on Taking Stock to tell you what to do, other than to find a good advisor and make a good plan. Yeah, and we've said it every single show, and then stick to that plan.
Amen.
Amen. So, okay, and that wraps up this.
I know, right? I think we made that point a couple of times. Yeah,
but no, so this 15th edition, you said in talking about it, there's a lot to talk about today.
There is,
and kind of summing up the year and looking ahead to what 2024 is going to bring, because you're looking ahead. That's what investment's all about, right?
Yeah. Well, number one, 2023 has, unless something changes drastically in the next week and a half, has turned out to be a very good year from an investment standpoint. Bonds and stocks, and stocks way more than bonds. But it was an interesting year. It was a lot of volatility. We dealt a lot with the Fed and raising rates, and then threatening to raise rates, and that caused probably 3 or 4 gyrations between being up for the year and being flat for the year. But this last 7 or 8 weeks, the S&P 500, the major U.S. stock index, is up almost 16% just in the last 7 or 8 weeks. That's a big move. That's a really big move, and thus, portfolios are up in that 15 to 21, 22% range. So a year that was iffy has turned out to be a good one. Yeah. Again, with a week and a half to go. But no, we've had some interesting things happen. We've talked about the threat of a recession. There was a threat of recession last year. There was a threat of recession this year. They were threatening a recession next year, and the numbers haven't panned out. We've improved drastically during this year, and some things that were being predicted did not even come close to fruition. So,
well, it's interesting, and hearing some of the news outside of us. You and I are talking about whatever the economy is, whatever the investment world looks like. How the numbers are going up and down, the interest rates, inflation, and everything else, jobs. Listening to other people over the last couple of weeks since last we talked, I heard them using that big term about the soft landing, and if Now I just went blank. Who's our guy?
Chairman Powell,
Chairman Powell,
the big guy.
I just went blank. But if Chairman Powell wants this soft landing, he's getting it.
Yeah.
So that was interesting to hear, elsewhere besides sitting across from Art Jarvis taking stock, people are talking about it, and that's exactly what's happening. These things are heading for that soft landing, and again, the warnings about what it means. You don't want to bring it too far down.
Yeah, you think I just make this stuff up?
I do.
No, and here's the interesting part. So last week, that you had the Fed came out and they made their announcement, and it was a foregone conclusion that they were not going to raise rates. But then it was also kind of a foregone conclusion that he was going to continue with the rhetoric that we may have to raise rates some more. Well, what happened, and there's a couple of things. There's expectations, but then there's surprises. Well, the nice thing about last week is the expectations were met, but there was a huge surprise, and the surprise was not only did he not mention that we might have to raise rates again, he made the comment that his prediction was they would actually lower interest rates 3 times in 2024. So we went completely from talking about potentially raising rates to now talking about. So that was a big change from what came out of the Fed. So that's why we've seen in the last week or so we're probably up another 4 or 5% in the last week just because of what came out of the Fed.
Confidence from the Fed Chairman Powell, I'm going to say that so I remember his name, showing up.
Yeah.
I mean, that it reveals itself in the fact that now, maybe that's what's finally happened. He's got some confidence in the numbers because, as you said, over the last 7-8 weeks now, that's a couple of months. That's almost a full quarter of a rise, and things are looking up.
Yeah, I've said to you before, the economy is a great big huge super tanker out in the middle of the ocean, and it takes forever for it to turn unless it's a pandemic and someone flicks the switch off. But this is not a jet ski. You don't do 180s. But this, I can't think of one person or one analyst that was talking about them making an announcement about 3 rate cuts. There's been a little discussion about maybe a rate cut or so next year, but when you start talking about 3 rate cuts, it's like really interesting. So yeah, it was a big surprise, and the markets liked it. And the other interesting thing is 2 months ago, you and I were sitting here talking about how we gave up all the returns in the market over the last month or so, 2 months at that time. But, in the 10-year Treasury bond, the interest rate was at 5% and actually kind of bouncing a little slightly above 5% at the time. We're at 3.9% now. So within the last 2 months, we've gone from 5% interest on the 10-year down to 3.9. That is a big move, and it is clearly a change in what's going on and the way things are being looked at by people and by investors. It's a good change.
How is the confidence level for Art Jarvis Global Investments? It seems to me that as we've done now the 15th, as we've done the previous 14 shows, 14 episodes, and taking stock, each time we're taking stock, taking a look at what's happening, and going through it, you've had a pretty solid confidence level of what's happening in the economy all along. But are you feeling some joy as 2023 closes and the forecast from the chairman is, hey, we're probably going to have 3 decreasing interest rate moves?
There's a line that says, "Don't fight the Fed," or something along those lines. That we have all these sayings in this business, and one of them is "Don't fight the Fed." Well, if the Fed's talking about lowering interest rates, that's good for that. That's good for stocks. That's good, So that works. That's fine by me. You have that. You still have And here's the other thing. It's not. I shouldn't say but it's not rocket science. Watch the economic numbers. The problem is we get off the ball. And you stop watching economic numbers and you start worrying about what everybody's saying. Okay, and you and I have talked to this ad nauseum about stick with the plan. And going forward, hopefully answering your question, is going forward, I'm looking at the numbers, and the numbers are continuing to improve. So we have continuing to improve numbers. We have increasing forward earnings projections for the corporations going forward. And we're talking about lowering rates. Well, guess what? If you get higher earnings numbers and you lower rates, that raises the market multiple. That should translate into higher returns in the stock market.
I look at it this way. Number one, I wanted to say this too because you were talking about the tanker and the jet ski.
Sure.
And I thought, I always mix in some other analogy, and we go all over the place. I need to jump in the water with you so we can stick with one clear analogy for the, But we don't want to be in a dinghy with oars.
No. And we were in a dinghy with oars for quite some time, honestly.
Right.
Those 3 years, we were in a rocket boat from like 2010 to 2020. And then next thing you know, we were overboard in that rowboat, just trying to bailing water out of the rowboat, right?
Yeah,
I mean, if you want to take that, how far you want to take that analogy, but yeah.
I didn't want to bail, but no, that again, that is a good part of that analogy because who wasn't? We were doing some bailing, and that's why the interest rates were climbing. Yes.
Yeah, well, yes. I mean, they had. I won't take it away from. In 2020, they had to do something.
Right.
All right. Or we were looking at some very bad extended time. So what they did was pump $6-7 trillion in the market. Well, and when and I browbeat the Fed in our 2 weeks ago in episode number 14. Right. Apparently, maybe he listened, but I doubt it. But it's.
I listened.
Yeah, well, I appreciate.
I heard it live, and then I heard it again. So.
But the problem is they had to do something, so they pumped trillions of dollars into the market. Well, economics 101, you pump that bunch of money into the economy, you got to watch out for inflation. Well, so we quote fixed what was going on, or attempted to fix what was going on. But what we did was we threw a whole lot of gasoline on the economic fire, and they had to spend a couple of years beating that back. And as I mentioned last episode, I think they started way too late. I think what happened in 2022 was unnecessary, but it is what it is. So, but the nice thing here is I think we fought that fight over the last 3 years, and I think we're getting back to a much better place where hopefully things aren't as volatile. Now, don't get me wrong, there's an election year coming up, so there's going to be a whole lot of rhetoric, and there's going to be a whole lot of this and a whole lot of that. It will cause some volatility, but hopefully, typically, an election year ends up being a pretty decent year.
Yeah. Well, with the improving numbers, and even before I go into that question from it, yes, we do hope that it's not as volatile just because of an election year. Mm-hmm. And it's like, why do we repeat that same mistake? It's an election year. At the end of it, somebody's going to get elected and things are going to settle, when the dust settles. It doesn't need to have all this volatility for 9 months of campaign rhetoric, as for this major election in November 2024. That doesn't have to happen. But anyway, that's a sidetrack there I didn't really mean to get to. Mm-hmm. But with the improving numbers and the improving forecasts, surprises right now are like we were hearing like the doom and gloom kind of, we're going to raise the rates and this and that, the inflation, and we're going for a recession, and we were pleasantly surprised.
Correct.
So here's so you go to a restaurant on Friday or Saturday night, and you get there and you see there's a lot of people, and it's like you walk up and say, what's the wait? Mm-hmm. Oh, 15 minutes. Okay, we'll stay. Here's my name. And then it's 30 minutes, 45 minutes. That's bad news.
Right. Sure.
So don't tell me right now. This is what I'm saying with the account. See, I'm out of the water again. I'm in a whole different analogy. We're at the restaurant analogy. I climbed out of the boat. I'm on shore, hungry.
I'm all good with the food analogy.
Okay. Well, and it's like lunchtime as we record this. Right. So here we go. But that aside, it's like don't tell me it's a 15-minute wait,
right,
and then surprise me with the 30 or the 45 minutes. So right, isn't there Can we really wrap our minds around and embrace the good news right now, or are they just trying to calm us with good news and good forecasts, and we're going to get surprised with some bad numbers. How do you, and again, this is like not the advice thing, but this is the helping the listeners. How do you discern, like, okay, and then stay steady and have a good plan for what's being forecast? How do you do that?
Again, it's numbers for me.
Yeah.
Okay, that's smooth, and it's not what was the number this month. It's what's the number? What have the numbers been for the last few months? What's the trend? What's the 3-month average? What's the 6-month average? And things like that. And as long as those numbers continue to hold steady or improve, from my outlook, it's like I'm at a best case scenario, worst case scenario, I'm not looking for something really bad to happen next year. So it's, again, it comes down to stick with the plan, because there's nothing that says to me it's time to get off the plan. This is not a 2008 in a Great Recession kind of scenario. The numbers look good. The numbers are reasonable, right? It's not, we're not trading it. We're not at 25, 26 times earnings or something like that, and interest rates are going up. We're at 18, 19 times earnings, and interest and earnings are going up, and it. Again, it's just there's always going to be a surprise. There's always going to be something. So I always make the comment with my clients, this is the plan, blah blah blah. As long as nobody does anything stupid. Well, there's a lot of people doing things that aren't that intelligent out there. Okay,
you can say a lot of people doing stupid things.
Well, I keep getting told, some people keep telling, quit saying stupid. But there's always something that rocks the boat. Now, is it something enough to right in that rocking of the boat, or doing something that doesn't help? Is that a short-term little bit of volatility, or does that cause a long-term problem? And again, I'm being a little long-winded, but you sit here and you look going forward, and it's like there's just nothing that I'm not afraid someone's getting ready to punch me in the face or something like that. So. Yeah, I'm positive. I am. I mean, does that mean next year's a 5% year or a 10% year or a 15%? That remains to be seen. Okay, and I mean we're doing a really good job of moving forward here at the end of this year. But most people tend to look at things in a calendar year. I don't. Right? I don't. It's 12-month periods, it's 6-month periods, it's 18-month periods. I don't care what month we're in.
Right.
So, but if you're going to look at this year, and let's say we end up, whatever it ends up being, 19-20% this year, but that will carry over in the next year.
Well, there's only a week and a half left. We're not going to go from 16 and a half to 19 or 20.
Well, we're up 16. I think year to date, I think we're probably up that 18-19% this year. Yeah.
Well, the point, and whittling down and editing to the point. So for advisors like you and their clients, you're going to see the trends. You're watching the numbers. So these like whatever the forecast is right now that says, hey, Powell just said probably going to have 3 reductions. Not looking to raise interest rates. Well, that's what he says now. And then here's a forecast for earnings for, the upcoming year. Well, between now and what could potentially be like a surprise bad news because they thought it was going to go this way, you're looking at those numbers. And so, sticking with the restaurant for just a minute, if I'm standing there and they told me a 15-minute wait, if they say, hey, Mr. Gibson, I told you 15 minutes, some tables are lasting a little longer. It might be 25. So you're going to see those numbers change, and it doesn't have to be a slap in the face surprise. I mean, I think that's the point at the end of the day. And again, the ever, as you said, ad nauseum, stick with the plan.
Sure.
But whoever your advisor is, whether it's Art Jarvis and Jarvis Global Investments and you're listening to this, or whoever you are working with, that investment professional, they're watching the numbers for you. You're not going to get slapped in the face.
Right. Yeah. And again, unless something really bad happens in the world, that is usually a gradual process. Right. So consumers are rocking and rolling right now. We got retail sales numbers last week. They were great. Inflation numbers continue to drop. I think we're at 3 or 3.1 on the inflation now. unemployment number was better than expected, and things like that. And it's still, I think if I'm trying to remember correctly, but I think it was 199,000, and they were looking for 170 or something like that. But the point is we're still right around that 200,000 a month job creation, which is pretty much normal. So
Right.
So it's there's things that you just look at and it's like that's good. And again, unless something bad happens in the world, I'll say it again. That it's something you can watch and gradually happen and make decisions. And again, the other nice thing is let's say we get a little bit ahead of ourselves. Let's say, okay, we had a great run and we're just got a little too far too fast. The nice thing is now there's actually a decent alternative. 2 years ago, if I wanted to move out of stocks and move the bonds, well, now I'm making 0.5 or 1%.
Right.
Today, if I want to move into bonds, I'm making 5.5, 6%. So it's a nice alternative. If I want to make 9 in the stock market, or I can make 5.5 or 6, you're not giving up a whole lot in order to protect the portfolios if you have to.
Yeah. We don't do this as like a call-in show.
Right.
Nobody can call in. We could solicit questions, but we don't do that. They would have to get them to us, and then I got to sit here and say so and so sent me this email with a question for you. But I'm going to throw one at you anyway. So and again, at the end of this, there's going to be a disclaimer from Art, but I'm just going to ask this question. So somebody, not in their big money investments, but somebody's got a couple $1,000s. You reminded me of this because you were talking about, the money marketplaces of, now you're going to get 5.5, 6%. Yeah. What are some of the options out there that people could look at? Are there some short term, or when you do a bond, does it have to be like a long term? What are some of the different things where somebody could, put some money, make some, 5% or 6% earnings? Can they be 3 months? Do they have to be 12 months or 2 years or 3 years? What are some of the options available to people?
There are literally thousands of options.
Oh,
I mean, if you go from hyper conservative right now, if you could put your money into a money market fund, and as of yesterday, it was yielding 5.26%.
Okay.
That's a stable value fund. Unless something really bad happens in the world, you shouldn't lose money, right? Then you can start to move your way up the yield curve. So you can buy 1 month, 2 month, 3 month, whatever you want, all the way up to 30 years in Treasury bills, notes, and bonds.
Right.
You can ladder a portfolio. So let's say you right now, and you still have somewhat of an inverted yield curve, meaning the shorter end is yielding more than the longer end. But the shorter end, I could ladder a portfolio that's 3, 6, 9, and 12 months of Treasury bills, and those are anywhere. Well, now they're probably 5.25 up to maybe 5.5. Literally just a month or so ago, you were in that 5.5 to 5.6 range on just that short term. So those are things that you can hold. If you buy a 3 month, you hold it to maturity, you're getting that yield that you bought it at. So there's that, and then the further you move up the yield curve, you're loaning somebody your money. In this case, the U.S. government. You're loaning them your money, but the further you go out the yield curve, the more volatility there is. So, and unless you're planning on buying a 30-year Treasury bond and holding it for 30 years, then you start to have some potential of losing money, or a higher potential of losing money the further you go out. So, but no, that's the beautiful thing about the markets, that there's tens of thousands of things you can do. Whether you're trying to make money, trying to protect your money, you can target certain sectors, you can target certain markets, you can target certain asset classes. There's just, the sky's the limit. Most of us are familiar with somewhat like a 401k plan or something,
Right?
And you get a whole bunch of target funds which say, hey, I'm going to retire in 2060, and this is how it's going to be automatic. And then you have, large-sized companies, mid-sized companies, but you only end up really with maybe, depending on which one you're in, let's say 20 or 30 options. Well, you go from a 401k going and let's say you roll it over into a rollover IRA, now you got tens of thousands of options. And again, things you can do to either make money or protect your money.
Right. So. The point, and what I was thinking is like, so maybe, younger people just getting out there into the world. They've finished college, they've gone out into the working world. It's not like they've got the hundreds of thousands of dollars to get with a big portfolio plan right away. But maybe they're able to sock a little bit away. And what are some of those options? Because as you said, right now, a few minutes ago is a 0.5%,
right,
like you said.
Yeah.
And now, there's actually some options there, as you said, obviously thousands of options where they could do something, even, short-term, long-term, to help to begin to build something that they can really create a portfolio from.
You know how a young person gets hundreds of thousands of dollars? They put away $100 a month and they put it in the U.S. stock market, and by the time they retire, they will have hundreds of thousands of dollars, and that's only $100 a month. So if you come out of high school, you come out of college, and you invest for 40 years, and you put it in the U.S. stock market, and again, this is historically, you're easily looking at hundreds of thousands of dollars. I don't care what 40-year time frame you pick, okay, and that's just $100 a month. They get a job, and the next thing they got a 401k, and they're putting more. They can put up to almost $20,000 a year away, and not on top of that, their employer is matching some of what they're putting away. So that hundreds of thousands of dollars can easily become a couple $1 million,
Right.
just as long as you're consistent and you don't touch it, don't mess with it. Right? There's custodians. At Procter & Gamble, walking out of Procter & Gamble with millions of dollars. And all they did was, for the last 30 whatever years, they put the money away and they let it grow. So that's how you do it.
Put your money away and let it grow.
Leave it alone.
That's getting your money working for you instead of you working for money.
There you go.
That's the key.
Yeah. I wish when I was 20 years old, or even younger, that someone would have told me, don't buy that little toy or whatever it is. Go buy some Microsoft or whatever. I always use Amazon as just this crazy story. Look at the company that Amazon has become over the last couple of decades. It started out as an online book company. You bought books through Amazon.
Yeah.
Now you're buying diapers through caskets, right? I mean, it has everything. And if you really want it bad, you can have it this afternoon.
Yeah.
So
I'll share one that's, I'm pretty sure whoever you are listening right now, and Art, you sitting across from me, you've heard of Coca-Cola.
Somewhere.
The Coca-Cola company. So, and you and I have talked separate of this, not taking stock. I'm a baseball guy. And there's a lot of people who are going to disagree or not like this, but Ty Cobb.
Mm-hmm.
Back when Ty Cobb was playing baseball players weren't making money. They weren't becoming millionaires. Ty Cobb was a millionaire.
Mm-hmm.
He invested as a young man in some company called Coca-Cola. Was one of the first investors in Coca-Cola. So, he put his money to work and let it grow. And that's our Christmas gift from taking stock today to especially, the younger investors out there right now trying to figure out, how do I do this? And gosh, where am I going to get the money? Hey, Art just told us $25 a week, $100 a month. It's you can come buy that. You can don't buy that toy or whatever that is, and you can be well on your way.
100%. And I like the Christmas present comment. I mean, it's was it Ben Franklin or somebody gets credit for saying, compounding is the eighth wonder of the world, and it is. And it's boring at first. If you're 20 years old and you're putting $100 away, and you got $100 and the market goes up 10%, you may just made $10. Congratulations! But guess what? Now you're 50, and you've got way more money put away, and that 10% is a much bigger number than $10. And that's where you see it. I mean, you look at the graph, and it's kind of going along, and all of a sudden it starts to look like a rocket taking off because of that compounding. And again, I'll say it one more time. You start early, and you're consistent, and you leave it alone, you'll have no troubles.
Well, and as we wrap up 2023, and as we wrap up Taking Stock, episode number 15, and everybody that's listening, you're going to get into 2024. That's a great New Year's resolution. Save it, let it grow, Leave it alone. Let it grow. Compounding interest. You never know. It becomes $10, becomes $100, becomes $1,000, becomes tens of thousands of dollars. Just thank you, Ben Franklin.
Yeah, right. We'll give him credit for it today. I can't remember, but yeah. No, it's you know, and again, it's been a great year. I appreciate you. Thank you for this show. I really truly do enjoy it, and it keeps me on my toes and things like that. And it has generated conversations with people that I probably wouldn't have had. But
Good.
Yeah, I would truly I wish you a Merry Christmas and a blessed 2024.
Thank you very much.
And same for all the listeners.
Thank you very much. Yes, definitely to all those listening to Taking Stock. Thank you for joining us in 2023. We invite you to come back. We're going to be back starting January 9th. Will be the next Tuesday that we get together for the next episode of Taking Stock, the first of 2024. But Art, to you and your family, your clients, and again all the listeners, Merry Christmas. And as you said, I think it can't be said better. A blessed new year.
Yeah.
Holy, healthy, and happy new year in 2024.
Couldn't ask for more.
It's been my pleasure. Thank you.
All right. Thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.